In this module, we will discuss about the macroeconomic stabilization policy and structural reforms in India. New classical macroeconomic theory treats long-term GDP growth as independent of any short-term macroeconomic stabilization policies. Alongside, it postulates that money is neutral and monetary policy affects prices, not real output in the long run. While high inflation and price uncertainty are generally considered to be detrimental to growth, the effect of monetary policy on growth, according to this view, is only temporary. The ultimate determinant of long-term growth according to new classical growth model is technology, which is treated as an exogenous variable in such models. The foregoing view of economic growth has been challenged by development of endogenous growth models. The endogenous growth models regard per capita GDP growth as an endogenous equilibrium outcome of the decisions by rational optimizing agents including firms, individuals and government. Such an approach endogamies the determinants of growth, Romer 1986, Rebello 1991, in the form of accumulation of physical or human capital, evolution of technology through research and development, and macroeconomic policy. Thus, endogenous growth theory provides a framework to understand the significance of short-run stabilization policy in the process of economic growth. After studying this module, you shall be able to understand the theoretical underpinning of the concept of macroeconomic stabilization, understand the conditions for macroeconomic stability, understand the factors that led to emergence of macroeconomic instability in India, know the concept of structural reforms, understand the interdependence between the process of macroeconomic stability and structural reform process, macroeconomic stabilization process in India, structural reforms in India. Let us now discuss the concept of macroeconomic stability. Now, one need to understand when an economy does tend to be unstable. There are two aspects of stability of an economy. One refers to internal stability and the other refers to external stability. Internal stability is defined as a scenario in which real capacity is at or close to its potential or capacity level, with a low and non-accelerating level of inflation. In accordance with concept, neither of two scenarios is considered to be meeting the conditions of internal balance. Low inflation coupled with slow or negative growth, or rapid growth coupled with high inflation. On the other hand, an external balance is defined as a scenario in which a current account position is sustained by capital flows with three caveats. First, terms at which capital flows to the host economy need to be consistent with growth prospects of an economy. Secondly, it will not entail any restrictions on trade and payment, leading to adequate and relatively stable level of international reserves. An external balance does not necessarily correspond to a zero current account balance or zero overall balance in balance of payments. A macroeconomic crisis generally takes the form of accelerating inflation and unsustainable fiscal and current account deficits in an economy and impairs its normal functioning. Now, we will discuss what led to emergence of macroeconomic instability in India. In simple words, the macroeconomic crisis got slowly built up throughout 1980s in the country because of imprudent macro management caused by living beyond means. The fiscal situation deteriorated throughout 1980s on account of ballooning of non-planned revenue expenditure, forcing government to increasingly resort to internal debt, growing dependence on internal borrowing to cope up with an expanding fiscal deficit continued eating up the vitals of the economy, eroding its capacity to any exogenous shock. The automatic monetization of budgetary deficit made possible by a complete denomination of fiscal policy over monetary policy led to a huge growth in money supply. This massive expansion in liquidity led to a shooting up of demand pressures in face of a scenario of stagnant supply. It fueled inflationary pressure and consequently led to building up of inflationary expectations, creating an overall inflationary environment in the economy. While inflation in the domestic economy made our exportable unattractive to rest of the world, the policy instrument of overvalued exchange rate in an attempt to provide cheap import reduced incentive to exporters. As a result, current account deficit continued to grow, leading to massive growth in external debt and the debt service obligations. Thus, it is abundantly clear that both the aspects of internal and external balance in the domestic economy remained precarious, created a scenario for the economy to reach a dysfunctional point. Thus, while the economy could absorb larger and more sustained shocks due to oil price hike in the 70s, it was not possible in the late 1990s. A relatively minor oil shock due to Gulf War brought opens the scores in the economy. Foreign exchange dropped to a level in January 1991, which is not adequate to finance imports even for 2 weeks. Foreign lending was cut off as reaction to the unsound macroeconomic position. It was a complete loss of face for the country when national gold reserves had to be pledged to IMF in exchange for a loan to cover balance of payment debts. The economy had to grapple with impaired internal and external balances, and a macroeconomic crisis was shaped by unsustainable fiscal deficit, mounting inflation and unsustainable deficit in current account. Thus, macroeconomic stabilization in the Indian context included fiscal adjustment, control of inflation and adjustment of balance of payment. Let us now understand the concept of structural reform. In its broadest sense, structural reforms simply mean changes to the economic governmental structure. If someone believes that there is something wrong with the society in which they live, they are likely to try and blame a crisis on that belief, which is intrinsically relates to their ideology. An ideology is a system of ideas and ideals, especially one that forms the basis of economic or political theory and policy. Diverse ideologies of different group of people lead to them to recommend diametrically opposite structural reforms. For a Marxist with no faith in market, such reforms mean nationalization of industry and finance. In stark contrast, structural reforms proposed by IMF reflect its predominantly neoliberal ideology in which market occupies a pride of place. Structural reforms in the Indian context included reforms in trade and capital flows, industrial deregulation, disinvestment and reforms in public sector and reforms in financial sector reforms. Moving into discuss the complementarity between macroeconomic stabilization and structural reform. Standard textbook discussions link macroeconomic stabilization to demand management and structural reforms to supply management. However, Little and Joshi 1993 argued that these two aspects of economic reforms cannot produce the desired impact in isolation and need to be viewed as complementary. They argued that in the absence of structural reform, the economy would be back to square one. Losses of public enterprises would continue to burden the budget, leading to fiscal deficit again. Trade restrictions will hamper the growth of exports, exacerbating balance of trade problems, and compulsory government capture of private savings will bring back fiscal indiscipline. Thus, the program of structural reform is viewed as indispensable for the success of macroeconomic stabilization process and must therefore go hand in hand. It may also be argued that structural reform process need to be supported by macroeconomic stabilization process as well to produce a meaningful impact on the economy. This is because the reform process on its own may add to macroeconomic pressures. In the short run, trade liberalization may worsen the balance of payment and financial liberalization may increase fiscal deficits by raising the cost of government borrowing. Thus, the process of structural reform may produce undesirable result in the absence of macroeconomic stabilization policies and jeopardize the reform process itself. They argued that the sets of reforms are mutually complementary because no one can work without the other. Next, we shall discuss the macroeconomic stabilization in India. Macroeconomic stabilization consists of having a low inflation with less variation and a sustainable balance of payment position. Mainly, three measures are followed for this process. First, the process of fiscal consolidation in India. India has been tackling fiscal deterioration by adopting a fiscal adjustment mechanism to improve fiscal stability. The crux of fiscal consolidation consists of creating a transparent system of public expenditure and preventing predatory actors from controlling the country's resources. In the past decade, India has enacted mechanisms to bind governments to fiscal rectitude through formal legal or even constitutional devices. To begin with, certain major fiscal adjustment mechanisms were introduced. They included medium-term fiscal reform programs MTFRPs in 2000-2001 for states, where the guidelines were devised by the Ministry of Finance in 2000-2001. It aimed at reducing wasteful expenditure, cutting low priority spending and improving tax collection or improving the efficiency of the tax administration. However, the MTFRPs could not achieve its target and the fiscal situation deteriorated over its period. A widespread deterioration in the fiscal position with an associated impact on fiscal sustainability, macroeconomic vulnerability and economic growth lead to an emerging consensus on the urgent need for imposing statutory ceilings on the central government's borrowings, debt and deficits. This led the passage of FRBM Act. FRBM Act. The FRBM Act requires that the centre's fiscal deficit be reduced to 3% of GDP and the revenue deficit be reduced by an amount equivalent to 0.5% or more of GDP at the end of each year beginning with 2004-2005 and eliminated by 2013-14. The debt to GDP ratio is required to be reduced by 68% by 2014-15. In response to the debt relief package recommended by the Finance Commission in return for fiscal correction, almost every state except West Bengal and Sikkim has enacted Fiscal Responsibility Acts. Second, management of inflation. One needs to tackle the issue of inflation on both demand and supply fronts. Besides containing fiscal deficit and checking monetary expansion, it is imperative to promote expansion of agricultural production and manage the supply of food grains and other essential commodities. Fiscal dominance of monetary policy, a basic reason for inflation, has moderated in India as a result of a series of fiscal and monetary policy reforms undertaken over the past 2 decades. The most notable of these were: first, movement to a market determined interest rate system by introducing auctions of government debt; second, phasing out of the automatic monetization of fiscal deficits through the two supplemental agreements between the Government of India and the Reserve Bank of India; and third, curbing the monetization of debt by enacting the Fiscal Responsibility and Budget Management FRBM Act 2003 mentioned in the earlier subsection. It has been commented in the literature that de facto monetization has not been completely phased out. As long as fiscal deficits remain large, the size of market borrowings will also remain large and impinge upon the conduct of monetary policy, no matter how the debt management is conducted. While in principle the Reserve Bank uses open market operations to impact liquidity and monetary conditions, in practice it is not easy to decipher what part of the open market operations were undertaken purely on these very considerations and what part might have been influenced by the consideration that large government. On the supply side, government undertakes various measures to accelerate industrial and agricultural growth rate. For agriculture, initially land reforms were undertaken to enhance the efficiency of production, and currently initiatives are taken on technological front to increase both intensive and extensive cultivation. Agriculture credit is another field which is being used to stop the exploitation of small farmers by big money lenders. The industry has grown initially on the basis of industrial policy of India, and at present various initiatives like Make in India and development of industrial corridors has been started. However, the growth rate of agriculture has remained satisfactory and industrial production has shown modest increase. But in case any one of them slows or does not match up with the population growth rate, then it will necessarily cause prices to rise. Thus, it is essential for the government to always keep a check on the growth rate of output and take necessary steps as dynamics of an economy changes. Third, sustainable balance of payment. India faced a severe balance of payment crisis in 1990-91. After that, the position has improved to a larger extent. At present, India enjoys the foreign reserves of about 3,52,020 USD million. In early 1990s, imports were compressed mainly to curb huge current account deficit. Imports were liberalized only when India was considered to be in a relatively comfortable foreign exchange reserves position. Further, there was huge deficit in the balance of payment position from 6th to 9th plan periods. This was due to tremendous rate of growth of imports along with a poor rate of growth of exports. The trade deficit during these 4 plans were so heavy that it could not be offset by the flow of funds under net invisibles. The exchange rate management has a crucial role in controlling the balance of payment position. India follows the liberalized exchange rate management system LERMS, which is a dual exchange rate for the conversion of foreign exchange earned by the citizens of India. This system has been very successful in managing the volatility. Along with this effort, the government also launched the India Development Bonds aimed at mobilizing foreign funds. The balance of payment position in India showed a gradual improvement since 1991-92 with exports covering a larger proportion of imports than in the earlier years. As a result of these efforts, reserve accumulation during 2004-2005 at around 4/5 of such accumulation during 2003-2004. And this helped maintain India's status as one of the largest reserve holding economies in the world. Let us now understand the structural reforms in India. As noted before, structural reforms are designed basically to deal with sectoral problems pertaining to the supply side of the economy. Since the initiation of new economic policy of 1991, Government of India has undertaken various steps to strengthen the structure of the economy. We hereby describe few measures. First is trade and capital flows reforms. In order to achieve the goal of globalization and integrating the Indian economy with the rest of the world, India took many steps like devaluation of rupee in July 1991, convertibility of rupee on trade account, considerable reduction in tariff rate and decanalization of many items. The devaluation of rupee enhanced the competitiveness of Indian products in the world market. The liberalization of imports with the reduction of high tariffs has also resulted in equality in prices of the commodities produced domestically and in foreign countries. Along with decanalization, export processing zones and special economic zones have been created to boost the exports. Finally, foreign direct investment has been allowed in many industries. Like the government has relaxed the norms for area restriction and the requirements related to minimum capitalization in the infrastructure development sector. Second is the reforms in industrial policy. Industrial policy was reconstructed to a great extent and most of the industrial controls were dismantled. Substantial deregulation of the industrial sector was done in order to bring in competition and increase efficiency. Industrial licensing was almost abolished except some industries. The list of industries reserved solely for the public sector included iron and steel, heavy plant and machinery, telecommunications and telecom equipment, minerals, oil, mining, air transport services and electricity generation and distribution was drastically reduced to 3: defense, aircraft and warship, atomic energy generation and railway transport. Further, restrictions that existed on the import of foreign technology were withdrawn. Third is financial sector reforms. Financial sector reforms have always been taken as an indispensable part of the comprehensive policy reforms in India. India has identified that these reforms are important for enhancing the efficiency of resource compilation and their allocation in the economy as well as for the overall macroeconomic stability. The reforms have been driven towards liberalization and various measures like liberalization in the interest rate and reserve requirements have been taken to achieve these goals. On the other hand, the government has accentuated on stronger regulation focusing at intensifying prudential norms, transparent manner and supervision to mollify the chances of systematic risk. Today, the Indian financial structure is intrinsically strong, operationally diverse, well organized and globally ambitious. During the last 2 decades, the Indian financial system has been increasingly deregulated and manifested to global financial markets accompanied with the launching of new instruments and products. Let us now summarize what we have discussed in this module. Endogenous growth theory model forms the basic framework to understand the importance of stabilization policy in the process of economic growth. Macroeconomic stability is both in terms of internal and external aspect. The internal is with regard to the real capacity of production in the economy and the external refers to the current account position of the nation. in India, macroeconomic instability was mainly due to imprudent macro management caused by living beyond means. Structural reforms in the Indian context included reforms in trade and capital flows, industrial deregulation, disinvestment and reforms in public sector and reforms in financial sector reforms. But the process of structural reform may produce undesirable result in the absence of macroeconomic stabilization policies.